there's an indirect tax, which is tax on
Expenditure.
Great. So with an indirect tax, which increases on for online businesses, right? Online sales. Okay. So if an indirect tax increases for online sales, that's specific anyway. So it increases the cost of production, right? Okay. So an increase in the cost of production, what will the impact be on products? The sales online. It will increase the sales, right? It will increase the price of sales online, right?
Increase the price of sales online.
Okay. Why will it increase the price? There's an increase in the cost of production, right? So if there's an increase in the cost of production, firms are supposed to respond, right? So their response is what?
Increase in price.
Yeah, that's what I'm asking you. So why is there an increase in price? There's an increase in price of a product because firms have to react. They have to respond towards an increase in cost of production. So the situation will be an increase in cost of production will reduce the quantity supplied in the market. Without reducing the quantity supplied in the market, you cannot raise the price. So the first thing they do is an increase in cost of production, find a way to ensure that consumers find it difficult to buy. They find it difficult to see the product. So the product is a bit scarce. So if the product is scarce, consumers will be willing to pay more for such product. So an increase in the cost of production reduces the quantity supplied in the market. So as soon as the quantity supplied in the market reduces, consumers will start looking out for the product. Then firms will be able to increase their price. That's one side. Another point is this. An increase in the cost of production for products that are priced inelastic, firms will be able to increase the price. Consumers will buy because the product is priced inelastic. But if the product is not priced inelastic, if the demand for the product is not priced, if it's not inelastic, it is difficult for them to raise the price. So because they cannot raise the price for not all goods, most of the goods are substitutes. Most of the goods are in a competitive market. So that's why when there's an increase in cost of production, the first thing firms will do is to reduce their supply so that the product becomes scarce on the market so that they can increase the price. Do you get it? So most of the products we have are products with substitutes. And one of the factors that determine the elastic or inelastic of a product is how competitive the product is. So if there's availability of substitutes. So most of the products in the world have substitutes. So when the price increases, the first thing firms will do is to reduce their supply. Then the demand starts increasing more than supply. Then they can increase the price. So an increase in the cost of production will shift the supply curve leftward, bringing about a high equilibrium price. Do you see how supply works now?
Yes.
So an increase in cost of production shifts the quantity supply in the market, contracts the quantity supply in the market, which brings about a leftward shift in the supply curve. And that would lead to a rise in the price of the product that has witnessed an increase in its indirect cost. Clear?